welcome to today's webinar. My name is George Radford and I'll be your host today. Today's webinar is very much focused on the UK property market, specifically tailored towards Ghanaian clients or clients based within Ghana or West Africa for that matter. As mentioned earlier, I see there's a number of people joining from various West African countries and some Southern African countries. So everyone's welcome. Thank you for joining today. And no doubt the content should hopefully be useful and relevant to everyone that has joined. Spencer's not joining us today, but my name is George Radford. I'm the Managing Director of the RPA Group for the UK and Africa. And today I'm going to give you a quick introduction to the RPA Group, to our business, the services we provide, have a quick look at the UK property market and why people invest in the UK property market, the outlook for the rest of 2024 and beyond in terms of the performance of the property market. We're then going to delve into Manchester as a case study. We have investments across the whole of the United Kingdom, but in the interest of time, I'm just going to focus on one development today, which is a new project in Manchester, and use that as a case study, as a worked example, I suppose, to help to build a slightly clearer picture, and then talk you over how the investments work and how the purchase process works. And of course, we can have a Q&A at the end. Should you have any questions, please feel free to put them into the chat box and we'll try and answer them as we go. So some background on the RPA Group. We're a global business, offices in 4 different continents. We've got a global reach, clients across every continent, which is quite an achievement. And we've to date invested over £1.3 billion into property on behalf of our clients. Our service offering is very much an end-to-end product and service solution, which I'll talk over a bit more in a second. 65% of our clients buy more than one property with us, which we're very proud about. Shows that we must be doing something right. And a key value add of our business is the experience of the founders, Richard, Giles, and I, who all have over 20 years of property investment experience. Some a lot more. And just wanted to point out, we are highly rated on Trustpilot. 4.8 out of 5, so we're very proud of that. Strive to provide our clients with an excellent customer service. So what does RPA do? So we provide clients anywhere in the world with the ability to invest safely, securely and efficiently into the UK property market with a strategy that is designed to optimize your return on the investment. So how do we achieve that? So at the outset, very much looking at the research and the due diligence and sourcing the investments with the best developers in the right locations, where you're going to get a really good product in the right place that's going to benefit from a very strong underlying economy, where there's a very strong demand for tenants on the rental side, but also where there's very high levels of capital appreciation, and when you wish to sell the property, high levels of liquidity. So once we've onboarded projects, done the due diligence, and given it the RPA stamp of approval, then we would undertake the investment advisory side, I suppose, understanding your requirements as a client, your budget and so on and so forth, and aligning that with the most suitable property investment to meet your investment goals and your investment horizons. Once we've identified the right property, then we will instruct solicitors, facilitate the legal process with one of our panel solicitors. We provide mortgage services by way of utilising our network of mortgage brokers, sometimes directly with the lenders, with the banks. We have our lettings and management business at the back end. So we would manage your 1-bed, 2-bed, 3-bed apartment in London or Manchester or wherever it may be. We would manage that for you. Make sure it's run efficiently, collect your rent from the tenant, pay that into your designated bank account, and then 5-10 years later, you wish to sell the property and we will liquidate it for you back into the secondary market. This is direct residential property direct ownership, where you fully own the title deeds, or you own it by way of a company that owns the title deeds to that property. You have full control over the investment. It isn't a fund or a syndication or a REIT or anything like that. It's bricks and mortar, which you own directly, as I mentioned, either in your own name or by way of some structure. We pride ourselves on working with the best developers in market. Just a few developers here. Some of the largest, Barratt are actually the largest, but some of the largest UK developers, some global brands there. So yeah, we pride ourselves on working with the best developers in market. Far East Consortium, another fine example, King's Crescent Homes, and so on and so forth. So that's really important for us to ensure we offer our clients best in market product. Just a point worth noting there, the UK still remains the number one investment market in the UK for global investors, and there's obviously a very good reason for that, because it consistently delivers. And just a recent Knight Frank report that high net worth individuals allocate 32% of their investment portfolios to residential real estate, followed closely by equities, 26%. The reason for putting that up on the screen is that if high net worth clients typically invest their money predominantly into residential property, then it probably is a good place to put your money. So why invest in the UK property? A number of reasons, and a lot of these will sort of follow across into other markets as well, I'm sure, tier one markets. But long-term wealth generation, we know if you buy well in the United Kingdom and you hold for 10 years, you will typically double your money. And that's been a consistent pattern since 1945. Passive income, rental income, leverage, the ability to take a property and use bank financing by way of a mortgage to purchase that property. So borrowing the money from the bank to buy is a real benefit of buying UK property, which other asset classes don't offer. And the financing is still relatively affordable compared to the likes of Ghana or Nigeria or most African countries for that matter. Stability. Most of our clients in Ghana, in West Africa in particular, are looking to invest into the UK for stability, currency diversification, currency protection, asset protection, succession planning for their children, retirement planning, making sure that you invest your money in a safe market where it's secure, so when you come to retire, there's no surprises down the line. And then obviously education planning is a massive one in terms of buying properties to generate wealth, to use that money to fund for a child's education, maybe in the United Kingdom, or if the child's very lucky, buying a property for them to use when they are actually studying in the United Kingdom, which is arguably the number one education hub in the world for international students. So just a quick outlook for the UK market. 5-year growth forecast, we're seeing UK average just under 18%. The best performers really in the Northwest and the Midlands, 20% plus. And you can see down there, Southeast and London sort of performing a little bit less favourably, but still sort of 16, 17, 18% growth over the next 4 to 5 years, which in GBP terms is very strong. And from a rental perspective, we're looking at 22, 23% rental growth over the next 4 to 5 years. Last year actually was the best year ever for the UK rental market, highest levels of growth, over 10% growth across the country, and in some places over 20% growth. So that was a very big positive amongst arguably a slightly more challenging market in 2023. Just a point to note at the bottom there in yellow, UK needs 300,000 new homes a year, currently delivering 120,000. So in short, a huge supply deficit and still a very, very strong demand. Simple laws of economics, low supply, high demand, increase in values. So let's just compare the UK market to other asset classes. or indexes. So Dow Jones, the Nikkei, cash in UK bank account, gold, and the FTSE were all outperformed by UK property over the last 70 years. So UK property delivering average annual return of 7.3%, which is not bad. Okay, so as I mentioned, we have investments across the whole of the United Kingdom. I'm not going to go through these points line by line, but what I've tried to do here is to highlight 3 of the major cities, the big commercial centres in the United Kingdom where we invest in property. London, obviously being the capital, the most populous city in the United Kingdom, 8.9 million currently, looking to expand by up to 9.8 million, 10% increase over the next 2 decades. So you've got very strong population growth. Still got quite a young population as a whole. It's obviously the commercial centre of the United Kingdom, and it's a massive hub for international students. 400,000 students, of which over 25%, 127,000 of those students in London are international students. So it's a huge education hub, as probably one is aware. The economy of London contributes to 22% of the UK's GDP. So it's quite an astounding figure. Almost a quarter of the whole GDP for the entire United Kingdom comes from the City of London. Not the City of London, London, to be specific. Just having a look at house price forecast for London, 17.5% growth between now and 2028. Rental forecast, 18%, 18.2% over the next 5 years. Again, pretty solid. The major infrastructure works taking place, new runway at Heathrow. Obviously, infrastructure is a key driver of property values. And then the HS2 link, which is going to be the new fast train running from London to Birmingham, halving the existing journey time. That's ongoing and will no doubt be late and complete in, I'd imagine, probably in the mid-2030s. Supply and demand, again, for London, the shortage of homes, 625,000 homes short between now and 2039. And again, we've got a housing crisis in the United Kingdom, which is not so good for local owner-occupiers and renters, but it's very good for investors. So what these sort of key points here show on the different cities, London, we'll move on to Birmingham now, and then Manchester. These are some of the key drivers, really, of property markets. It doesn't matter where you are in the world. These are some of the key factors. If you look at and they have positive figures, then it should create an environment for a very strong and sustainable and stable property market. Population, students, the strength of the economy. You can see Birmingham as a city, it's the second biggest city in the UK, but it's dwarfed by London. 115 million people, it's almost a tenth of the size. And then you look at the GDP figures, 2.7% GDP compared to 22% for London. So again, about a tenth of the size of the economy of London. So this is the second biggest city in the UK, but compared to London, it's actually rather insignificant. Yet it's a fantastic place to buy property because you get much better value and you get much better yields. I'm not going to go through all of these. We will share the presentation with the webinar link, and please obviously go through them in your own time. And house price growth forecast for Birmingham, which we will also see in Manchester, is significantly better than London, 21.5% growth over the next 4 to 5 years. And rents also mirroring that, around 21.5% growth over the next 4 to 5 years. There's a huge amount of infrastructure improvements taking place in Birmingham. HS2, as previously mentioned, running from Birmingham to London, the expansion of the airport, the Euro Football Championship, which will further pump money into the city. And once again, there's a real shortage of homes in Birmingham, 80,000 units shortfall. Now let's look at Manchester. Lots of similarities really with Birmingham. Manchester, not as big population-wise, but economy-wise, it's the second biggest economy in the United Kingdom from a financial services perspective. 85 FTSE 100 companies located there, over 100,000 students again, so it's a real education hub. and yeah, a city that is absolutely booming. GDP figures here on the bottom right hand side, same as Birmingham, and again about a tenth of the contribution to the UK's GDP when compared to London. So there's lots of facts and figures in here, and just mindful of time, but I suppose the point we're trying to get across is when we're looking at property markets, we're very analytical. Data is really key, and understanding some of this data here can help us to take a calculated view on the outlook for a property market over the next 5 to 10 years. When you've got strong population growth, strong economy, growing student numbers, especially when you have high levels of student retention, big levels of infrastructure improvements, and a shortage of homes, it really culminates in a very nice environment for property growth from a capital growth perspective, but also from a rental value perspective. So what I'm going to do now is to go into a case study for a new development that we have just launched in Manchester called the Falcon. And it is a fantastic new development with Far East Consortium. Excuse me a second. Excuse me. So Far East Consortium, big listed developer. Delighted to be working with them again. This is central Manchester, and this is Victoria North up here, the biggest redevelopment, regeneration scheme in the north of England, £4 billion gross development value, 1 billion of which is being put in by Far East Consortium, and effectively rebuilding this whole part of Manchester. New roads, railway station, parks. There's going to be parks amounting to 115 acres, which is about a third of the size of Hyde Park in London, for those that know Hyde Park. So significant, going to change the landscape of Manchester. New health centres, commercial facilities, retail facilities, and 15,000 new homes. So super exciting project. And as we know with these redevelopments, these regeneration projects, getting in early, getting in at the outset, getting good value for your investments, and then holding those for a medium long-term horizon invariably results in making significant returns on your investment as that regeneration really takes place. So the area we're going to focus on is this part here, Red Bank, which is the southernmost part of the regeneration scheme and the closest part to Manchester City Centre. In short, it's a 10-15 minute walk to Manchester Piccadilly Station, train station that runs directly into London. You're a 10-15 minute walk into central Manchester. I walked it myself the other day. And football fans, you're not far away, unfortunately, from Man City Stadium, but you go the other way and you'll get to Manchester United, Old Trafford, which is a much better place to be in my case, but not at the moment. So very well connected, very well located, and just all in all a fantastic and very, very compelling investment. Just to add a bit more colour, so this is the Falcon here, this block here. Over here you've got Victoria Riverside, these 4 blocks, sorry. So this is phase 1 under construction, due to finish next year. And then phase 2 is all of this, essentially. The first block of which is this one in the middle, the Falcon, and then the clubhouse is down here. So, summary, the developer is Far East Consortium, 20 floors in total, 1 and 2 bed apartments, 189 units. You've got the clubhouse literally on the doorstep of the Falcon. There's a bar, there's a gymnasium, private dining facilities, co-working space, and a residence lounge. So really fantastic world-class facilities on your doorstep. The development has a 3-year build period due to complete in Q1 2027, and we'll have a look at the payment terms and the prices and how that all works in a minute. Just to add a bit more colour, some images of the development, finished to a super high specification, as one would expect from Far East Consortium. Click through these. There's the clubhouse. You've got your restaurant and roof bar, which is a fantastic facility here, and then your gymnasium, co-working space, private dining areas down below. To build a bit more colour. Nice place to go after work. Okay, so hopefully that helps to build a slightly clearer picture. So how does it work? So firstly, our clients, we've got clients globally. You don't actually have to leave your country of residence to purchase a UK property. Within reason, there are no restrictions in terms of nationality for individuals to purchase UK property. And the process is relatively simple. Everything can be done electronically nowadays, which is great. And foreigners can qualify for mortgages as well, which is great. Less favourable terms than a UK resident, but we can still help clients to secure financing into the UK market. That's a big benefit. And enable you to benefit from owning a UK property in your portfolio and all the benefits that we looked at earlier that come with owning a UK investment property. So how does it actually work? So we establish your investment requirements. We understand your needs, your budget, your timeframes, your investment goals. We align that with the most suitable product, and then we go through the product selection, identify the unit that is most suitable for you. Then that unit is secured by way of completing a reservation process. So sign reservation form and typically the payment of a £2,000 reservation fee to secure the unit. Stage 1 complete, unit secured, off the market. Solicitors are then instructed, and within 30 days of the point of reservation, you would do what's called exchanging of contracts, where you become legally obliged to purchase that property, and the developer becomes legally obliged to deliver that property under the contract of sale. And at that point, on signing of the contract, you would then look to pay 10% or 20% deposit, depending on the actual development. The payment terms vary. Then you wouldn't have to do anything, again, depends on the project, but typically you wouldn't have to do anything over that construction period. There may be some stage payments, which we will see in a minute. For example, in Manchester on this project, there are stage payments. Some projects you might put down your initial 20% deposit and then not do anything for another year or two until it completes. Other projects you might put down 10%, a year later pay 5%, a year later pay 5%, and then a year later complete on the purchase. They all vary. But by rule of thumb, you reserve the unit, you pay your reservation fee, unit secured, you instruct solicitors within 30 days, you pay your initial deposit, you exchange contracts. Then 6 months prior to that property physically completing, you apply for your mortgage, you secure your mortgage, the mortgage is ready for drawdown prior to practical completion and legal completion of that property, i.e. when you get the keys. And then when the property is ready, you complete on the purchase, which might be a year, 2 years, 3 years from the point of reservation. We get the keys, we go and market the unit, we do the viewings, we secure your tenant, and then we start collecting the rent, and then you start receiving GBP rental income into your nominated bank account. Just to take a worked example from this development, the Falcon. So this is based on a 2-bed unit on the first floor, 808 square feet, £363,500, based on a 50% mortgage, just by way of an example, can get higher, 60, 65% loan to values typically. Wouldn't recommend anything or suggest anything higher than that, but just to make an easy example, let's work on 50% loan to value, 50% mortgage, 50% equity. So the payment terms, £2,000 reservation fee, as we discussed a minute ago, 10% deposit on exchange, £36,600, 4 to 6 weeks later, £18,175, so a further 5%, 1 year after exchanging contracts. So 2 years later, after 2 years after exchanging contracts, a further 18,175. Sorry. Then you don't do anything until completion, and then you pay your balance of 30%, £125,000 approximately, giving you a total equity contribution of just over £200,000. So just to recap, £2,000 reservation fee on securing the unit, 4 to 6 weeks later, 10% deposit, a year later, 5% deposit, a year later, 5% deposit, 3 years from now, on completion, the balance of the 30% deposit, which in total equates to 50%, across the construction and on completion, which gives you a total value of £200,000, just over, in terms of your equity that you have to put into this investment, which includes all of your purchasing costs and your equity deposit contributions. So what I've put over here is just a very basic example based on the rental profit made on the investment and the capital appreciation on that property over the 10-year period would result in an 85% return on investment. So 85% return on the money, the £200,000 that you have put into the transaction. Obviously, as you increase the mortgage amount, if that were to go up to 60%, you're going to put in less equity. You're only putting 40% as opposed to 50% into the investment. And as a result, the overall return on investment would increase probably from 85% up to probably 95%, 100%, pushing on to probably 10% return on investment per year, just to give you an idea. Okay, so that concludes the presentation. Sorry, I know I covered quite a lot there. It's really just to give a flavour as to the RPA Group, who we are, what we do, how we add value, the services we provide, why invest in the UK, what type of product should you be looking at, how does it work, and how can you benefit from doing it. My recommendation would be, if you are interested, please do get in touch. We'd be delighted to hear from you, arrange a one-to-one consultation, and then understand greater your investment goals, your needs, and then tailor the right solution in order to meet your investment horizons over the next 5 to 10 years. Everyone's requirements are different. Everyone's accessibility to mortgage financing varies. Everyone's budgets vary. So yes, best done on a one-to-one consultation. And hopefully you've got our contact details. They are on there. Please do get in touch, and we will share a copy of this webinar presentation shortly. There's quite a few questions that have come in. I'm just mindful of time. I'm trying to keep the presentation to 30 minutes. So what we will do is we'll endeavour, there's dozens of questions that have come in, over almost 200 people that have joined. So what I will do is we'll endeavour to come back to you individually and answer those questions. And I'd just like to say a big thank you from the RPA Group and from myself, George Radford, to everyone that's joined today, predominantly from the beautiful country of Ghana. And we look forward to getting back into Ghana soon and seeing everyone. And we look forward to speaking to you maybe on a video conference meeting in the coming days and weeks. Thank you very much. Take care, and wish you all the very best.